Hello, YouTube. My name is Justin, and after a tough week of trading, you might be wondering whether we are bullish or bearish. I know that after a tough week like this, I am a little bit confused, and I am not 100% sure whether we're bullish or bearish. So this weekend, we're going to make our effort to go through, sift through the data, and come up with a strategy on how we can try to avoid some pain and maybe make some money this week. So let's jump straight in. And you're probably also noticing that the format for this weekend is a little bit different, doing that intentionally because there's been a lot of data to go through, and I'm trying to condense these videos down to be more digestible, easier to understand, and straight to the point. So the first slide here is going to be showing us that we have a doji in an uptrend. If you're not sure what that means, it just means indecision. So indecision in an uptrend means what? We're bullish. So until we get confirmation, not just price action, we need the confirmation, we remain bullish. That's the easiest way to summarize where we are right now. We're going to be focusing on the SPY chart, and that is the S&P 500. So again, the blue lines basically show us that we're pointing up. So if we're pointing up and we've been pointing up for a year, would it be reasonable to assume we're going to keep pointing up? The answer is yes. Is there potential for us to go down? Answer is also yes. So what does that mean? We have indecision in an uptrend, which means the base case is that we're still bullish with bearish potential. Why? We have a really big test here. If we just keep going sideways for 2 more weeks, we are going to break that first uptrend, and we could push back down to about 440 to test this lower uptrend. That's the easiest way to summarize where the market is at right now. And I would just note that keep in mind that the title we use for the video and the thumbnail is mostly for the YouTube search. It's not to have a definite answer one way or the other in terms of where we're going to go. Why? The only thing that's for sure is that nothing is for sure. So something new I'm going to try to do for this next week, for these videos going forward, is to tell you why would we be bullish, why would we be bearish, and the surprises that I could see on the horizon to potentially push us one way or the other. So why are we bullish? Well, we have existing uptrends on the weekly and monthly time frame. What does that mean? We are bullish until proven otherwise. The bear case is that the Fed is getting hawkish, and we are only starting to unwind. What does that mean? It's been 2 years of liquidity, and we're only starting to unwind that. That would be obvious if the tech sector was selling off more, which it is. It is leading the decline. Finally, what would surprise me this week? Well, China economic data coming out on Monday when the U.S. market is closed for Martin Luther King Day. We have Joe Biden addressing the nation with a formal press conference on Wednesday. Geopolitical escalation. Don't want to get into the specifics. You should know what that means. Earnings season is underway with banks kicking it off on Friday. We have a muted week this week, but we're starting to get into the full swing of things. Finally, we have options expiry or OPEX for VIX on the 19th. And SPY, SPX, QQQ, and everything else on the 21st. It's also a shortened trading week with 3 out of 4 days having options expiry. All right, let's move forward. So what are the summary of dates which could potentially move the market here? So we've got the dates lined out here all the way till Feb 2nd. We look here and see that on Tuesday, what day is the 19th? Let me just double check this. Tuesday is going to be the 18th. The 19th is going to be Wednesday. So we look here, we got Wednesday, Thursday, Friday for this week with a preview for the following week. So the reason why this matters is because in order, we're going to see what could potentially move the market on Wednesday. And again, I've chosen the most important relevant stuff here. So if you want more information and all of the normal things you see, those are all in Slack in the SPX channel. If you're not sure what that means, just click on the link in the description to find out about our community and join us there. Again, if you're enjoying the stream at any time, I would really appreciate if you could click on that button to make the thumb turn blue. So on Wednesday, Joe Biden has a formal press conference. It's likely going to be an update to the nation regarding where we are with Voldemort. We also have VIX monthly expiry. What does that mean? The volatility index is going to be expiring on the same day the president speaks. There could be some potentially bumpy roads. On the 20th, which is going to be Thursday. This is the day where there is a lot more data. We have European CPI. And the reason why that matters is because right now, the European area is still very accommodative with no plans to hike like the U.S. is right now. So I think it's like an hour and a half after we get that Euro CPI print, we also have the ECB monetary policy, press conference, and everything that goes along with that. We also have USA PMI, or Producer Manufacturing Index, coming out that same day. Finally, at the close, we got Netflix earnings. So Thursday is also going to be the only day where there is not any options expiring. And this is the day that I could see as being potentially disruptive going into the Friday, where we have SPY, SPX, QQQ, monthly OPEX, which is monthly options expiry when we normally see the motivation for enhanced volatility. I would expect we're either going to close at 460, 470, or 465 on Friday. That is my base case. Why? That's where max pain is. That's where they can burn the most premium. Finally, a preview for the following week on the 25th, which is going to be the Tuesday. We've got FOMC day one. We got Microsoft earnings after the bell, not yet confirmed. And then I'll have to check and see if these are confirmed now. If there's any updates, I'll post those on Slack. Finally, on Wednesday, this is the big one. On Wednesday, we got the day two of the FOMC. That's why it's highlighted in yellow. We have a press conference, a Q&A, and this one's going to really matter because we've been hearing rhetoric changing pretty fast from the Fed. Also in regards to how fast we're going to hike, when we're going to hike, and what hiking looks like. We also have big tech earnings kicking off. So again, Netflix reports on the 20th. And then after that, we got Microsoft, Tesla, Apple, Google, Amazon, and Facebook, all by the second. So as we looked at that chart from before, the doji, that becomes increasingly important because the focus is going to be shifting towards tech. Why? Tech is still the biggest component of the market and the one that has the biggest potential to push or pull in one direction or the other. So with all that data in mind here, what we have to understand is that we're in a doji with indecision with a big test coming up in the next 2 weeks. What does that mean? If you're going to choose to trade or remain invested through these next 2 weeks here, you need to be aware for the potential. Last weekend, we went through and laid out the bear case for 2022. I'm not going to beat that drum again, but you just need to be aware that the wheels are already in motion for me. We just don't have the confirmation yet on the technical chart. Fundamentally, we should already be down. Technically, we are not. So if you're going to trade through this period, just be mindful that the risk is quite high until we get to about February 2nd. Why? If we wait until the 2nd and we get early confirmation that the wheels are still in motion, tech is going to rally, that's not going to be the end of the rally. We're going to start in February and go all the way till March when we have our March FOMC meeting with the summary of economic projections. So what does that mean? Again, reminder, repeating myself again here. If you choose to trade this week and next week, be prepared for increased volatility. Sitting on the sidelines and just waiting for the chips to fall might be the better option. Why? Being emotional, getting really chopped up this next week is going to make it even harder the following week when we got big tech earnings kicking off. So for me personally, I'm close to fully invested, but I know exactly what I want to see to exit. I have fewer names than I did at the beginning of the year, which means I have less damage to control. I'm also in names that have already paid me, which means that if they do end up hurting me and I lose money, I am okay with that. I won't be happy, but I will be okay because these stocks have treated me well. And when I go back to them, I am more than happy to do that if I think the risk reward is good. All right, now let's go through. And again, this is a new format. If you're enjoying it, destroy that thumbs up, drop me a comment and let me know. I'm trying to make it even easier to follow through where I'm taking the information from my normal presentation and condensing it down into a PowerPoint. So this way you as the viewer, you're able to better read what's going on, and I'm piecing together a story for you. And this takes me time to do, right? Making a PowerPoint, going through and creating the narrative takes time. I enjoy doing this, but make sure to show me some support by clicking on the button to make the thumb turn blue, please and thank you. So on Sunday night, again, just remembering that we opened up on a gap down. So why did we open up on a gap down? Well, it was Goldman Sachs. They said on Sunday, we now expect the Fed to hike 4 times, ceased faster runoff in 2022, starting in July. So they started the week off soft. And if we look here, again, really close, this is a hollow red candle, which means that we closed higher than we opened, which means that we are more bullish on Friday than we were on Monday. Thank you, Goldman. Thanks for giving us the dip. And then Tom Lee here. So again, I'm pulling through things to try to tell a story because these guys are smarter than me. and I don't pretend to be as smart as they are. So Tom Lee, again, from Fundstrat, is telling us that the markets are trying to price in the first Fed hike. And we heard that news coming out on Sunday. And on Friday, we're closing a little bit higher. So the question is the bounce going to hold? Are we going to go down anyway? And what does it all mean? On Thursday, after the market was already showing some signs of reversal, again, we'll go through that in a moment here. Goldman Sachs coming out again and telling us that if you're worried about a bubble, why you should be overweight U.S. equities this year, according to Goldman Sachs. Valuations alone aren't a reliable signal to get out of equities, cautions the CIO of Goldman's Consumer and Wealth Management Division. Oh, and then on Friday, we had a huge snapback. This was right after there was a big drop on Thursday. So why did we listen to Goldman Sachs? Because Goldman's most elite rank to get millions in special payout. What does that mean? They're very good at their jobs. They win. And Bank Ready Special Award for its 400-person partner class. And the reason why I find this particularly interesting is because so far, the earnings reports from JP Morgan's trading desk have been lackluster. Goldman Sachs reports on Tuesday pre-market and Morgan Stanley reports on Wednesday. And by looking through and seeing how the trading desks are doing, we should know whose narrative to listen to more. Mike Wilson over at Morgan Stanley has been beating the horse about we're going down to 400 or 4,000 SPX. It hasn't happened, which means that if they've stayed with that playbook through to December of 2021, they probably didn't do that great trading. Goldman Sachs, on the other hand, had an end-of-year target of 470, and that's basically where we are right now. So Goldman appears to be the winner by a landslide. And if we see that narrative coming through, we have to make sure we listen to Goldman Sachs. Why? They appear to be right. Do they have ulterior motives? Are they trying to get us into a trap? I don't know. I'm just looking at whose narrative or playbook the market is more focused on. And as of right now, it is Goldman Sachs. Even when Joe Biden, who is the president, was talking about his Build Back Better, when Goldman Sachs downgraded the economic forecast based on the bill not passing, he quoted Goldman Sachs. Oh, Goldman Sachs said if we don't pass this, we're going to have a little haircut on GDP growth. Goldman Sachs matters big time. Everyone knows it. You should too. So as you can probably see, now, to make it very obvious for me and for you, the viewer, we're moving into the potentially bullish catalysts for the week ahead. That's why we got a bull here, if it's not clear. And if you like the bulls, smash a thumbs up. And if you like the bears, hang tight. We'll get to that narrative in a few moments here. Powell said all the right things, but inflation has a mind of its own. So what I'm just going to go through here is a couple of news headlines, not the actual articles that try to tell you the story. We all know inflation is here. We all know it's real, but again, don't fight the Fed. And when the Fed right now is saying that inflation is not going to persist, it's going to be back at 2.5 or 3% by the end of this year. That is where there might be a disconnect between what the market wants to do versus what the market is doing. What do I mean by that? Right now, we're assuming the Fed is correct. And if they're not, that's where things could dramatically change. Why? Because central banks, not Voldemort, will drive global economies in 2022. The biggest risk this year is that policymakers call the post-Voldemort recovery wrong. They are planning to hike into a time when we are planning to see increased weakness. We're seeing weakness start to emerge. And it might be the exact worst time to be tightening monetary policy. So there's a chance of a misstep here. Jerome was there at the head seat in 2018, and I think he's trying to avoid what happened then. What are they doing to try to avoid that? They are communicating well ahead of time. They are not trying to catch the market by surprise. They're trying to tell them exactly what they're looking for and the reasons for that. So looking here, we can see this is the new Fed dot plot. What this basically shows is the FOMC members' dot projection for meeting dates 12/15 of 2021, basically going back to the meeting minutes. And on the 25th, we have a new meeting. We're likely going to get a new update on these dots. And all the dots tell us is we look at two lines here. We look at the white line and we look at the green line. So the white line tells us the Fed funds futures rate, latest value. And then we look at the green line. It tells us the median estimate for the Fed's interest rate. What does that mean? In 2021, we were basically at 0.25. Going into the end of this year, the dots are a little bit more spread out, but the median is here at just below 1%. Call it 0.75. It's 0.75 to 1%. So what does that mean? The market is currently expecting about 4 hikes. And we've been hearing, at least I've been hearing, that balance sheet runoff could be considered the equivalent for a rate hike. What does that mean? Maybe 3 hikes and balance sheet runoff begins. We look through to 2023, and now we're here at about 1.5 to 1.75. And then through to 2024, now we're at about 2%, and longer term, 2.5%. When we look at here at the white line, the Fed funds futures, what that tells us is that the market's not currently pricing in what the market is, what the FOMC is communicating. So what does that mean? This white line has to tick up to meet the green line. And if in February, if on the 25th of January, the Fed communicates what they've been saying over and over, including the doves like Lael Brainerd, Daly, Williams, means we're probably going to get a little bit of repricing on the 25th, where this white line goes up to meet the green line. That is the bullish narrative where they've told us well ahead of time, we're planning on moving the line up. If we move the line up, is the market going to already be able to digest it because it was told ahead of time? Just like they said, we're going to double the taper. We're going to run off faster. The market digested it and pushed higher. So that's my big question. Looking here now to a couple of headlines. Again, these are from Bloomberg for the most part. Furious rally sends the Nasdaq to biggest rebound since March of 2020. Nasdaq 100 averts 5th straight fall on Monday with small gain. These are great buy on the dip opportunities. Are they? Well, let's look and see here. Is it lions' courage or sheep led to slaughter? That's the question for retail dip buyers who kept hurling fresh cash at increasingly turbulent NASDAQ stocks. Investors emboldened by a strategy that worked all of last year plowed more than $1 billion into tech in recent days, with nearly every other sector also getting deposits. JP Morgan Chase said it saw the strongest retail flows on record, with at-home traders adding $5.9 billion to equities in the week through Tuesday. Record inflows from retail. Is retail smart or is retail dumb? That's the question. Are they going to get burned or are they going to cause the next leg higher? Biden's Wall Street watchdog to have agenda that shakes industry. Sarah Bloom Raskin would help lead crypto climate change push. I'm specifically talking about crypto here. Why? She is going to be very important when it comes to crypto regulation. So again, she would help lead crypto. What does that mean? Well, Powell told us that the update from the Fed in terms of a digital coin, the white paper should be out in the next few weeks. Joe Biden has not yet officially confirmed the Fed nominations. And Sarah Bloom Raskin, if she's confirmed, then we have to assume that's going to be just in time for the Fed coin. So Powell also said that private coins could compete with the Fed digital dollar. What does that mean? This could be the potential bull catalyst for crypto, where Bitcoin, Ethereum, and all the other altcoins could move higher on the official confirmation of this headline. The flip side here could be that it could be a sell the news, where the market already knows this. So again, normally we sell off on the news, but because since we're already down in crypto, maybe this is going to be some relief. That 40,000 barrier is very important. All right, the bulls had their fun. Now it's the bears' turn. And again, if you're still watching the stream, I would appreciate a thumbs up, please, and thank you. Look at that cute bear, right? They're cute when you look at them, but then when they start attacking, that's when it starts to get a little bit more scary. All right, Henry Kaufman, 1970s Wall Street Dr. Doom, blasts Powell on inflation. Kaufman questions Fed Chair's stamina to tame prices. Former Solomon chief economist urges immediate rate increases. Whew. All right, this guy used to be working at Solomon. The Solomon Brothers is arguably worse than Goldman Sachs. Back in the day, they were one of the lead manipulators. This guy was he was the chief economist at the head manipulation firm. So when he's saying, I don't trust this Powell guy, he's also, I think he's 94, which means that he's actually lived through he's lived through exactly what everyone's talking about when it comes to we haven't seen inflation like since the 1980s. This guy was trading. He's actively watching the markets right now too. So he has a perspective that most people don't. Again, we're not going to read the whole article. The headline tells you what we need. Tech stocks stumble to worst start since 2016 on rate hike fears. So what does that mean? Well, we noted last week that Crypto is off to its worst start to the year since the dawn of crypto, while tech stocks are off to their worst start since 2016. Even after Friday bounce, Nasdaq 100 is still down for the year. I think we're down about 10% from peak to trough on the Nasdaq so far. Higher rates jeopardize heady stock prices based on growth. Why? The next article here tells us that what's behind the tech wreck. Hint, it's not all about rates. With earnings season approaching and no one sure what will happen, there's more to focus on than inflation. So what we noted at the beginning, like I said, is that Netflix is going to kick off the big tech earnings on, I believe, on Wednesday, and then all of the rest of big tech, I'm talking about the trillion-dollar companies, all report by February 2nd. So it's not just me saying be cautious over the next 2 weeks; they're confirming it too. And we'll tell you the reason why. Why? The market is trying to price in the first rate hike, says Tom Lee. So if it's trying to price it in, not actually priced in, that's what we have to be aware of. The market is trying to price it, and the market is doing price discovery right now. What does that mean? We don't know for sure what it's going to do. We need to see what's going to happen here. On the flip side, if we actually hear about there actually being 4 rate hikes, that could be interpreted as bearish. Why? We'll tell you. The question looming on investors' minds is, can tech earnings weather further rate shocks should the 10-year Treasury yield rise to 2%, as many now predict? While it's not exact science, a simple math exercise shows profit from the Nasdaq 100 firms would need to climb 9% for the benchmark's price to stay where it is and maintain its current valuation relationship with bonds. That might be a high hurdle to clear. Analysts expect software and internet companies to report a 5.9% increase in 2022 profits. What does that mean? It's pretty obvious to see that we're going to be at 2% by 2023, 2024. So if these earnings reports come in soft, the market's likely going to take a leg lower. And right now, the base case is that they're not going to be able to deliver the numbers that people expect. What does that mean? Repricing. All that money that retail put into these stocks is probably going to get torched. The surprise here would be if they're able to deliver what Wall Street currently does not expect. These companies are incredible. I'm talking about Apple, Amazon, Netflix, Google, Facebook, Tesla. They're able to just keep gushing cash and keep delivering what people want. So if it's been working for the last couple of years and now it doesn't, that's when it could actually give us a big hangover. Finally here, as a result, the Nasdaq 100's earnings yield, a measure of profit relative to share prices, has been whittled down to 0.85 percentage points above the 10-year Treasury rate, the smallest advantage since October of 2018. And what happened in December of 2018? We had a 10% correction in 1 month. And who was the head of the Fed? Jerome Powell. I think he's trying to avoid it. It's a very fine line to walk. And this has happened quickly. At the beginning of 2021, there were, we can just skip that, right? So again, we know the differential between the NASDAQ and the 10-year note is getting more compressed. So what does that mean? The wheels, right? The playbook's set up. People looking for that negative move lower. We just haven't had the actual confirmation yet. So again, going back to the first slide, we're bullish until proven otherwise. And we have areas of support and resistance which are now established, and we're going to go through those now by looking at the charts. All right, SPY monthly chart. So what we can note here is that we're pointing up. We have a higher high, just a little bit of a higher high, and a higher low with a hammer. What is that? It's bullish until proven otherwise. What is not materialized, which is what I wanted to see to push higher, is looking back to the pattern here with the arrow, where we get a hammer like we did in December, and we don't dip. We actually pump fresh, big pump. We didn't see that at all. So we actually opened up a little bit green. It started to materialize, and then it fizzled, right? It came all the way back down to 456. Whew, right? Not so pretty. So monthly chart, technically still bullish, technically still trending up. And the threshold here for the bulls remains at roughly 459 on a closing basis. It's really important we also maintain this higher low. As of right now, the monthly low is at 456. So as long as we maintain that, again, it gives us a cushion here for February. So as of right now, bulls remain in control on a monthly time frame. Looking forward here to the weekly chart. What do we have? Well, we noted what we talked about on the first slide. We have a doji in a bull trend. That's bullish. 465 apex into 465 is the uptrend test into next week. So opening up roughly flat, we're going to be on the blue line. What does that mean? That's our uptrend. We should find support there. If we don't, we're probably going to start pushing down. Where? Well, the low of the week is 456, so I'm watching that area very close. Actually, I think the low of the month for January is actually like 452 or something. I forget. It's 450 something. I forget exactly. My apologies. So what I'm going to be watching for here on the weekly chart, if we get an inside bar, it means that the following week, when we got big tech earnings in the FOMC, is going to be the absolutely deciding factor as to whether or not we're going to push higher or lower. An inside bar means more consolidation after a doji, and then we're going to find out who breaks it. Breaking bullish would be printing a higher high, and breaking bearish would be printing a lower low. If we do that this week, as of right now, we've got 2 weeks where we have a lower high and a lower low. So if we get another week of a lower high and a lower low, meaning we lose that 456 low, that's not pretty. The wheels start getting more in motion. We start getting early feedback that maybe the bear market is starting. Moving closer here to a daily time frame. So nothing has really materially changed. We're basically going sideways. How do we know that? Well, we look at the green line and the red line. And for the most part, on a closing basis, we spent all week inside this range. What is a little bit notable here is that we've spent 2 days under the 50 DMA, and we snap back. And now we have 2 more days below the 50 DMA. What does that mean? It just means that we're not finding clear dip buyers to not only buy, but then to push us over. So the reaction to the 50-day moving average right now really matters. And again, a couple days below, previously we spend 1 day below, right back above, 1 day below, right back above. You can look back in time, and generally speaking, when we spend 2 days below, which we did already the week before, we usually fade. So that's the big concern here, is that on a daily time frame, again, when we go to shorter time frames, we're getting more data. On a daily time frame, we are starting to see some warning signs where we're already going flat. We go up, we go flat, and then we have a chance to go down. So monthly and weekly still pointing up. The daily chart is already flashing a warning. It's a yellow flag, not a red flag. Also on Monday, we're going to break this downtrend by just opening up flat. So what does that mean? We're going sideways with a short-term downtrend, and we're over the green line with an IHS here, roughly the head and the shoulder here at about 462. All right, finally moving forward here to the hourly chart. So what does the hourly chart tell us? Well, this is the shortest time frame that we like looking at, and what it tells us is that there's no clear direction here. We were going down, we stopped going down. Oops. So we were going down, and then we stopped going down, just like we were here, right? We were going down, right? Had the downtrend. This is after Powell was speaking. Powell speaks. Whoop, 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 right up. So we have that same potential this week too, right? We stopped going down. We're starting to go up, which is like the first candle here where we push over the VWAP. So we push over the VWAP, ride the VWAP, ride the VWAP, lose the VWAP, reject off the VWAP, reject off the VWAP. Try to reclaim the VWAP, digest it, finally reclaimed it. That could be the snapback. We could be right here. I don't know. So on the shortest time frame, meaning the hourly, we have an IHS neck, which remains at 465. And we're going to get a Tuesday at noon test for 465, which is where the green arrow is. What does that mean? If we're above 4655 at Tuesday noon, that's starting to show that we're getting some bullish momentum here. 467 would be our Tuesday apex at 3 p.m. So into Tuesday close, which is going to be the equivalent of Monday because we don't trade on Monday. That is where this right here, that's where we find this 467 with this uptrend. That's called an apex, where 2 levels meet. So the 2 levels that are meeting here are going to be the white line with the uptrend. It's basically a test for the bulls. Finally, we have our blue line right here for 470.5. And that remains our most important test here. That's going to mean we're back above the 50, the 200 MA on the hourly, so the short-term and long-term price. And that's our chance for the bulls to snap it up and to go higher. So at Wednesday noon, we have a test here for 470.5. So if by Wednesday we're moving higher, that's really bullish. And then finally, that's it. So what are we clocking in here for time? Right. What do we got here? Good luck this week, right? So clocking in at roughly 30 minutes. That's the video. You're probably noticing some parts are missing. It might be a little bit more condensed than you're used to. But I think that going forward, this format is much more sustainable. It adds more value, and it should be easier for you to digest. Finally, if you want more information regarding the potential bear catalysts for this year, I encourage you to go watch last weekend's video, and we'll leave a link to that in the description. Thank you very much for watching, and I would really appreciate your support by, again, smashing that thumbs up, subscribing to the channel, and dropping a comment, because we're going to bring you the story as a follow-up next week. Good luck this week, and I look forward to seeing you either on a regular scheduled stream starting on Tuesday or in Slack. Thank you very much.